All right.
Okay, so good evening once again. My name is Mark Brain, and my co-host is AC Clement, the northern man. They, re they refuse to invite me, so I won't come. I will go to another country.
No, you soon come around there.
Ayo, I hear. All right, so the theory aspect. I want us to take it from this point. We all need money. That is one problem. A lot of people contact me on daily basis and it's like, I need money and I want to trade. And then in my heart, I know it won't work. But sometimes you just have to assume that it will work. But it end up not working. The reason is that they jump so many steps. That is the reason. Okay. Now, the point is you can make money from trading, and it is possible to make money from trading. But if you identify trading and you are just coming into it immediately because of the money, you will lose the little you have. That is one big problem in Ghana, Nigeria. South Africa is a little bit better. Hence, we make it look like trading is not luxury or as they preach. But the beautiful thing is that at the end of the day, it is luxury. Now, there is an important message in the video. Who remembered, please? Anybody? Anybody had an important information from the video? Nobody. Okay, let me remind you. Know your number. Now, know your number grows from your daily expenditure. Yes, Abraham, patience is part. Plus, know your number. Good. Now, when I bought this course, I mentioned the price. It is not fake, it's real. 5,000 US dollars. The content over 13 gig. Is it 13? About 60 something gig. And I use the internet to download again. I hold it like egg. But interestingly, few things that I loved so much from the course I bought, which I did not even watch the rest yet, is habit and its power, money routine, winner's identity, mental conflict, and risk management. Because I am very good in technical analysis. Like on Sunday, I do market review on Sundays, and the projections I've done for gold, as we can see on the screen, everything played out perfectly. So before I I try to know what is wrong with me as far as trading is concerned, the first problem was risk management. I want to make all the money in a day. The beautiful thing is that, which is equally ugly, is that the first time newbie you open MetaTrader, you deposit money. That first time, that second time, that third time is always a win trade. Then things turn around because of two things: greed, excitement. plus the third one, anxiety. So when we fix this problem right now, it means that, and you listen to it, you will not waste 7 years, 10 years before knowing what and how to approach trading. The other side of the story is that trading is addictive, very addictive. It's more than cocaine, guys. Once you start, you will hardly come out of it. So some people who go with luck, they end up become gamblers. They don't care anymore. Any little money they get, they just put it inside. They lose, they look for another one. Just like they do in lottery or sports betting, all those gambling games. But there is another way to treat it so you never become a gambler. Please be making notes. It's very, very important. This session is more important than identifying support and resistance, because you can identify support and resistance, spot your demand and supply, your imbalances, your accumulation, your order block, and all those stuff. As far as you don't know how much to risk per trade. Risk management is not all about stop loss and take profit. No. Risk management goes beyond stop loss and take profit. Risk management is more or less like the fundamentals, the foundation. That's rock you will build your trading career. Once you miss it, you can build your story to about 20th floor and it will sink. There's a common question I ask people. I was able to grow $100 to $1,000 and I lost all. The question is, how did you grow your 100 to 1,000? Why did you forget how you build it to the extent that you lost the 1,000? That aspect is also called money management. Then we go to the level where you factor the number of trades you take and strike a ratio and be able to identify or make a profit or break even or make a loss, which is what? The risk to reward ratio. Couple of all these come to that extent where we have dealing with what? Emotions. Dealing with what? Emotions. After that, putting all this together with errors and mistakes you make on daily basis, you write them down, which is in your trading journal, things that you put in your trading plan, and then one way or the other, you go against it. All of them come together and come under the topic trading psychology. Trading psychology. After all these, when you practice for a while, you can become a professional trader. Then you can boldly say, I have a strategy. What is the evidence of that strategy? You have proven reasons why it worked and proven reasons why it didn't work. By the time you get there, you will even be known for an asset. You will be known for an asset. Oh, this man, when you go on his platform, he trade gold. Oh, this man, he's only for Euro US dollar. This man is for Great British Pounds US dollar. Because you fish and fish and fish, then you're able to spot that asset that always moves with a plan or according to your setup. All right. So know your number. Before we break it down, this is the question. Let's do a little bit of a calculation. They said risk 1% of your equity in a trade. That is general, which is correct. Now, the reason why this is an advice is that if you are trading with $1,000, before you finish losing that whole $1,000, let's assume every day when you take trade, it's just hitting stop loss. Every day is hitting stop loss. Every day is hitting stop loss. It means that you should be able to trade 100 times before you finally blow your money. Now, the secret is that there is no way out of that 100 trades, 50 or 40 or 30 or 10 will be what? Correct. All right. Now, 50, 20, or 10, when you now add it to risk to reward ratio, it could equate back to your 1,000. Hence, you might be losing little or be in a break even. There is a point in time that you ask yourself, why am I losing trade always? What am I doing wrong? What am I not seeing? Are my observations right? Are my strategies okay? Am I getting the right confluences? You said no, then you fix your error. You might never blow that $1,000, but end up growing it to any amount you wish. But let's say you are trading with $100,000. Someone should give me 1% of 100,000. Anybody, please? 1% of $100,000. Someone should help me with that real quick.
$1,000.
$1,000. Okay. Okay, so $1,000. Now, my question for you is that, let's say, well, you have some money somewhere, which is actually a free money. And that free money, you're following the rule that risk 1% every day or anytime you take a trade. Now, if it is anytime you take a trade, it means that you are risking 3% in a day. That is $3,000. Be frank with me, truthful to yourself. Won't you get emotional if you lose $1,000? Will you get emotional if you lose $1,000? Yes or no? Now, if you lose it 10 times, that is $10,000. Then you start asking yourself, hey, am I safe? Hey, will this thing work? Hey, am I on the right track? Fear comes in. Now, your number now comes in with a calculation called your expenditure, right? Which is daily expenditure. Am I right, well? Divided by 3. So it means that you could be trading with $100,000, but your stop loss for the day won't be $1,000. Your stop loss for the day will now come into how much do you spend in a day? How much do you spend in a day? Okay, let's say you spend $100 in a day. Okay, so you just have to divide it by what? 3. That gives you about 33.3, if I'm correct, dollars. Now, 33.3, if you use this value as a stop loss out of 100,000, market hits stop loss, for instance, will you feel it? Please, yes or no. Out of 100,000, market hits your stop loss, and then you lose $33.3. Will you feel it? Yes or no? Will it pain you like $1,000? Definitely it's no. Now, the same way, let's say market go your way, like in your favor, and then you make something, let's say about $150. Will you be overexcited? Definitely it's no, because you are looking at, oh, my number is 100. So if I make 150, oh, it's still normal. If I lose $33, it's still normal. But the point is that when you accept your loss in a certain way, which is very reasonable, you will go into the game again. In trading, anxiety, rage, anger, happiness. We want to prevent these four things from happening. Now, when you prevent these four things from happening, it means that fear will not come in, boredom will not come in. Then at the end of the day, oh, I can't do this thing anymore. It won't happen. Right. Now, at the beginning stage, when you are building yourself, this calculation is very important. There is a point coming in your life as a trader where you have already made your equity. Let's say you are trading with $100,000. Okay, let's say you're trading with $1,000. You are able to grow it to, let's say, $2,000, just little. Then you now take out the $1,000. Maybe it now remain a profit of $2,000. Your blood, your real blood, is out of the market. What is now left is what? Your time. Initially, when you deposit immediately, your real money, which is your blood, is in plus time. After you take off the equity from the platform, you now have time, which is the profit. At least you can start adjusting your rules. But before you adjust your rules, you need to document it. Okay, I am actually going to use 0.3% the first month to test my skills. You write it down. And then when I'm progressing, I will increase it to 0.45. When I'm progressing, I will increase it to what? 0.65. When I'm progressing, I will increase it to 1.0. When I'm progressing, I will move it a little bit above 1.5. Why? You have a reason and proven method of what is working. And because you are keeping track record of it, you can keep repeating it on daily basis. And you will realize that trading is even friendly than you thought. You will understand that it is not riskier as you were told. You will understand that it is familiarized because you are doing what the market wants. Risk management. It goes beyond. We are going to apply it practically at the same time. Now, most of you will start trading with demo. Apply these rules as you start demo. Take your demo account like it is a live account. Assume it's your real money. Don't just go and use 20 lots because they've given you a practical equity of $100,000. So you just go and use 20 lot side. You leave the trade. Days later, you come and say, "Oh, I'm making money. I cannot put live money inside." I'm sorry, you'll be disappointed. So treat the market from the beginning as a business and get proven information as to how you get result A, result B, result C, and result D in the game of trading. Will become your friend and you will make a lot of money at the end of the day. Set realistic goals for yourself. Don't get to internet that you see how I turn $100 to $200,000 in 24 hours. Well, maybe he did it to annoy you. Okay? Maybe he has already made over millions of dollars from the market and he decided to gamble with just $200. And you are having just that $200 and you want to go and gamble with it. Understand your number and work with that number, and trading will become friend to you. You become a friend to the market, and the market will become a friend to you. You will do what the market wants you to do. Okay, the market is always moving in a good direction. You just move with it and you make your money. All right. So this is just version 0.01 for risk management. We're going to break it down. All right. I can repeat it 100,000 times. Don't get tired of it because that is the backbone for you to become a successful trader, right? It is not about you being afraid of losing. They're two different. It's different from you being afraid of losing. But the most important thing is that you understanding why the trade did not go well, and then you have equity to go in again. That is all I'm trying to let you understand. All right. So let's go to our normal work, support and resistance. Interesting things so far. Then let's break down some few stuffs. All right, so when we look at this trade, like I said, I annotated some key points. Annotated some key points in the market, right? Let me circle some of them, please. So when we take this area, for instance, is 1. Then this whole area happened to be 2. This whole area happened to be 3. Okay. Now, the interesting thing is that the new area we are going to be looking at is this area. Okay. Just like this. This area just like this. And then this area from here. This whole area as 1. Okay. Now, what is happening at those areas, at those places, is that there is nothing like support or resistance before they were formed. Okay. I want you to understand from the point that it is not about just drawing a line that this is support or drawing a line that this is resistance. But an area where market has something to do, an area where market stop and breathe, and based on the reaction will tell you what the market will do. If it is at the base, we are looking at a support area. If it is above, we are looking at resistance area. And what do you do at the resistance area? You look for sell opportunities. What do you do at the support area? You look for buy opportunities, validated buy opportunity with a confluence. Confluence is talking about 2 or more reasons why you are buying or selling. All right. Now, when we take this purple line into consideration, it happened to be more or less like a middle line. Happens to be more or less like a middle line, right? Now, before we get to advanced level, you need to understand the basis of support and resistance. You need to understand the basis of support and resistance, and then how it converts to support and resistance zones, and then how it then push to what? Demand and supply, and then how the others come around. Now, when we take this area, for instance, price came there, price was there, price came here again. So at this particular point, we can consider this area being what? A support. Consider this area being a support. But before then, here and here, it acted as a resistance because there was a price rejection there. Now, there is no magic how to get it. You use historical data to forecast it. That is the only secret. Now, when we look at this area, price touched this area, it got rejected a little and pushed down and break it. So it was acting as a resistance, but did not hold. Now, there's an interesting thing there we are going to look at when we are growing. Then it went to the top, do something and come back. Okay, so let's look at this point. It broke this line, trying to convert it to a support, but the support couldn't hold. Then it now come here and make this area a support, and price came to this area. After price came to this area, it couldn't break to come to the highs or the tops it created. It couldn't even enter this line. Then it pushed back, but couldn't touch the purple line. Then came to the top here, but couldn't touch the yellow line. Now, as it is doing 1, 2, 3, and 4, it is scaling and telling you something. It is telling you something. I am changing direction. Then after that, you see it broke the purple line, push back, make this point now a support again. When we are growing, we understand there is a reason for that. And then this one come a little bit above, and now rested at this area. Then making this area a resistance again, because price couldn't break it to the blue line or the yellow line. Hence, it now come all the way down. Now, many people will see this green candle formation and try to what? Buy. And the market goes against them. Because many of them will just assume this is a support area. So once price get there, they are expecting market to buy. That logic is wrong. When market get there, look at all the necessary reactions of price. Look at the size of the candlestick. Yes, this is a fundamental candlestick. The impulsive is high, heavy. Do you think market can just reverse immediately? Well, something like this happened here. But that doesn't mean on historical data, it will happen like that, right? Aside that, if we are even using candlestick formation, we did not have any evidence to enter a sell, a buy on this particular area. But looking at this candlestick here, and few other movement we will expect here, there could be a probability of we expecting market to change direction when we have all the necessary evidences, right? Now, at this particular area, I have spotted a zone or many reaction point of price. So even if I'm looking for a buy opportunity here, where will I be putting my take profits? I will now be using the levels above 1, 2, 3, 4 as my stop points or places where I think market will get to and give me take profit. So using as it is, it will be going up after I got all my evidences that this market will buy from maybe this purple line. I am very sure I get all my evidences. I will now use the up lines or the up reaction point as technical take profit areas. Then I will then be looking at the probability of it not going in my favor well and put my stop loss at the desired place. That one too is technical. So let's break it down a little. I am going to use, let's say I'm putting my entry here. So I'll be looking at how much profit stop loss I want. Mostly, I will set the stop loss outside my zone in case market want to play within these areas. It will not just stop me out before continuing my direction. Okay. But then if I want to make this decision, I will climb up to the bigger time frame and see the probability expectation at this base to be sure if market is reverse. So I'll be looking at, okay, maybe I'm targeting here, or I'm targeting here, or I'm targeting here. Now, any of these targets will depend on the type and kind of trader you are. Any of these targets will be based on the type and the kind of trader you are. Maybe you are a swing trader, or you are a day trader, or you are a scalper, right? Now, already I am projecting this market on a bigger time frame, which is a 4-hour time frame, right? So if, let's say, I come to 15-minute time frame or 1-hour time frame, there are some mechanical stuff I will get there that can help you make an informed decision, right? But then when you project it from the bigger time frame, it also helps you to eliminate too much noise and indecisiveness from the market. So you're able to project properly. Okay. So let's look at this point here. I want to circle something interesting. So we have 0.7 free as risk. And then we have 1.96% as profit. Okay. So my stop is 14. My take profit is 38.5. Right. So what it means is that at the end of the day, this is where you now use PEEP multiplied by your lot size to determine cash value risk or cash value take profit, which is your stop loss and your take profit. Your stop loss is all about, okay, when I put in, I'm expecting $1,000 as my profit, and I'm risking maybe $100 in case market did not go in my favor. I'm accepting to lose $100, all right? So that is the only amount that will be subtracted from your equity. Now, when that happened, we look at this ratio, we can see that the stop level is smaller than what? The win level. So we can boldly say, okay, there is proper R to R. Proper risk to reward ratio is applied. Now, if this market goes down, I say I hit stop loss 0.73. Technically, this is now technically, I lose less than 1% of my equity. Now, if you are still forcing yourself to, let's say, use the 1% rule, well, then maybe you may be thinking of adjusting your stop loss. Maybe, okay, I'm making it compulsorily 1%. Okay, which is technically it might not be a good idea. Well, it's also going to be based on how you factor your PEEP calculation at the end of the day. So these are some of the basic elements we will try and focus to make you understand, to make your trading journey a success. Okay. So for today, we touch risk management, then we touch key areas market reacts, potentially giving you resistance or support, or resistance zones or support zones. Then they also influence the decision of demand area and supply area at the same time. The movement also gives you patterns to be able to validate those setups being a demand area, a supply area, support and resistance, or support zone and resistance zone. It also gives you some candlestick pattern formations at those areas you also know, like engulfing, morning star, evening star, Aramis, rejection candles, all those stuff. When price is also going there with that fundamental approach, you will be able to see the momentum of the market movement will be reducing, and you'll be seeing more wicks to what? More bodies of the candlestick. It also varies currency or asset to asset. For instance, this my friend gold, the story is not the same. It is extremely volatile. Okay, it's extremely volatile. There is money there as well. Every trader likes volatile market. Okay, but it's all based on your risk appetite. All right, that one you can type it for me. It based on your risk appetite, right? But as you are starting, don't increase your risk appetite too much. Okay, so you can stay in the game a little bit while correct all your errors with that first deposit you are making and grow it. Thank you so much. If you have any question, we have some few minutes to what break it down.